Good day, everyone. My name is Hannah Daffny G. Indiano, and I will be reporting the second half for Chapter 7 entitled Fixed Income Securities. Before we proceed to the discussion, we should recall what bonds are.
Bonds are investment securities where an investor lends money to a company or to a government for a set period of time in exchange for irregular interest payments. Once a bond reaches maturity, the bond issuer returns the investor's money. Fixed income is a term often used to describe bonds since your investment earns fixed payments over the life of the bond. Companies sell bonds to finance ongoing operations, new projects, or acquisitions. Governments sell bonds for funding purposes and also to supplement revenue from taxes. When you invest in a bond, you are a debt holder for the entity that is issuing the bond. Many types of bonds, especially investment grade bonds, are lower risk investment than equities, making them a key component of a well rounded investment portfolio. Bonds can help hedge the risk of a more volatile investment like stocks, and they can provide a steady stream of income during your retirement years while preserving capital. The following are examples of bond certificate. The bond certificate usually has three information on the front. The first is the issuer's name. It is the name of the governmental body or business issuing the bonds. Second is the face value. It is the amount the bondholder would be repaid when the bond matured. And third is the interest rate or the rate of the interest the issuer paid the bondholders.
So now that we already know what bond is and what its key features, the next thing that we're going to do is to evaluate those bonds. Bond valuation is a process of determining the fair price or value of a bond. Typically, this will involve calculating the bond's cash flow or the present value of a bond's future interest. As the bond's par value and interest payments are fixed, an investor uses bond valuation to determine what rate of return is required for a bond investment to be worthwhile. So, to further understand bond valuation, we will go through this exercise. XYZ issued $3 billion of 6% bonds maturing on March 15, 2012. An investor who wishes to purchase one of these XYZ bonds on March 15, 2005 and requires on this particular bond issue. Assume that the investor will hold the bond until maturity and will receive 7 annual interest payments of $60 each. To calculate for the bond valuation, we must compute the present value interest factor of an annuity, which is used to calculate the present value of a series of future annuities, and present value interest factor, which is used to estimate the current worth of sum of money that is used to be received at future date. In this problem, the bond will be held until maturity and will receive 7 annual interest payments of $60 each, and we will multiply it by its present value interest factor of annuity, and the principal of $1,000 at the end of 7 years will be multiplied by its present value interest factor. The answer would be $895.36. In other words, an investor requiring an 8% return would be willing to pay approximately $896 on March 15, 2005. Clearly, the bond and the rate of return has an inverse relationship. As the rate of return increases, the value of bond decreases. If the rate of return decreases, then the value of bond increases. The next topic that we're going to discuss will be all about perpetual bonds. Perpetual bond, also known as a consol or perp, is a fixed income security with no maturity date. The valuation of perpetual bond is simpler because it has a finite maturity date. Assuming that the bond pays a fixed amount of interest per period forever, the value is as follows. Present value at time zero is equals to interest over investors required of rate return. Canadian Pacific has 4% perpetual debenture. What is the value of 1,000 bond to an investor who requires an 8% rate return? The solution would be the present value at time zero is equal to $1,000 times 4% perpetual bond over 8% rate of return. The present value at time zero is equal to $500. It is the amount the investor is willing to pay. Our next topic would be yield to maturity of a bond. The yield to maturity of the bond is the total rate of return that will have been earned by a bond when it makes all interest payments and repays the original principal. In other words, when we compute for the yield to maturity as a rate that discounts all the cash flows from the bond at the same yield to maturity rate, what we're assuming in effect is that each cash flows can be reinvested at the yield to maturity rate for the period until maturity. Another type of bond is zero coupon bonds. It is the type of bonds that pays no interest over their life. The only payment to holders is a principal payment at maturity. The price of a zero coupon bond can be calculated as follows. Price is equal to M divided by 1 plus R to the exponent of N, where M is equal to maturity value or face value of a bond, R is equal to required rate of interest, and N is the number of years until maturity. If an investor wishes to make 6% return on a bond with $25,000 par value that is going to due in 3 years, they will be willing to pay the following. Price is equal to $25,000 par value divided by 1 plus its rate 6% to the exponent of 3 equals 20,991, which is the amount the investor should be willing to pay. The last topic that we're going to discuss is all about preferred stock. Preferred stock is a component of share capital that may have any combination of features not possessed by common stock, including properties of both equity and debt instrument, and is generally considered a hybrid instrument. The preferred stock has its own unique distinguishing characteristics and features. First is selling price and par value. It is the per share price at which preferred stock are sold in public. Second is the adjustable rate preferred stock. It is when dividends are reset periodically and offer returns that may vary different interest rates. The third is the cumulative feature. It is a type of preferred stock with a provision that stipulates that if any dividend payments have been missed in the past, the dividends owed must be paid out to cumulative preferred shareholders first. The fourth feature of preferred stock is participation. It is when the holder is given the right to receive dividends equal to the customarily specified rate. The fifth is maturity. Technically, preferred stock has an unlimited life because they have no fixed maturity date, but it may be called after a certain date. The sixth feature is call feature, or it is callable. It is when the issuer has the right to call in or redeem at a preset price or to repurchase such issued stock after a defined date. And the last feature is voting rights. Generally, preferred stock are not entitled to vote. As discussed earlier, it is said that preferred stock is a hybrid instrument since it is part of the stockholder's equity like common stock, and it is a long-term debt which is considered a fixed income security. So, preferred stocks and common stocks have similarities and differences. Their similarity is that both common stock and preferred stock represent an ownership stake in the company and have the ability to pay dividends and trade on an exchange. The main difference between preferred stocks and common stocks is that preferred shareholders have the priority over the company's income, meaning they are paid dividends before the common shareholders. The second difference is that preferred stock does not have voting rights to shareholders while common stock does, meaning they cannot elect the board of directors and does not have the voice in the future of the company. The third difference is that preferred stocks may have the option to be convertible into common stock, while common stock does not have the option to be convertible into preferred stock. Most preferred stock pays regular fixed dividends. Preferred dividends per share are normally not increased when the earnings of a firm increase, nor are they cut or suspended unless the firm faces serious financial problems. Thus, the investor's expected cash return from holding most preferred stock can be treated as a fixed, constant amount per period. Because many preferred stock issues do not have maturity dates, the cash flow from holding no maturity preferred stock can be treated as a perpetual stream of payments or a perpetuity. To solve for the value of preferred stock, the equation goes present value of time zero is equal to dividend per period divided by investor's required rate of return. Let us assume the 2-pound pays annual end-of-the-year dividends on its 4.50 series B cumulative preferred stock issue. Its issue price is $100, par value is 0. What is the value of this stock to an investors who require an 8% annual rate of return on investment? Assume that the issue will not be foreseeable in the future. So let's solve together the problem. In getting the dividend per period, we need to multiply the $100 issue price by the 4.50 series B cumulative preferred stock, and we divide it with the 8% annual rate of return, resulting to $56.25. So this will be the value of our preferred stock at present value of time zero. So, this concludes my presentation on Chapter 7 Fixed Income Securities. Thank you so much for your interest and attention.